It's not a bad policy. It's not a bad strategy. It's not a bad benefit. But don't think you're going to double your income at 86 years old when you need long-term care. That benefit's gone. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice and get into the nitty-gritty. As always, text your questions to 913-363-1234. Again, 913-363-1234. And remember, this show is just a show. It's not financial advice, so make sure you do your research. David, what do we got today?
Hey, Mike, can you really get long care insurance through an annuity without any health exams?
Yeah, long-term care insurance.
Okay.
They probably sent in a typo. That's okay.
Okay, yes.
I've been guilty of having typos myself on texts.
Yeah, I
Okay.
wondered about that. I thought that. But yeah, so this sounds complicated. This sounds like some...
Yeah, we're not the grammar police. That's okay. We'll get it. So, okay. The question is about long-term care insurance and can they get it through an annuity? All right. So, David, let me pitch you this idea, okay?
Okay,
I'm an insurance company.
all right.
I make lots of money on taking on risk, knowing the odds are in my favor. But guess what? I'm going to sell you an annuity. It's going to double your income each year for your long-term care. You're going to have it for life, all is well, and I'm not even going to check your health. Does that sound like a good deal?
Yes, if you're not going to check my health, yeah.
Yeah.
Sounds like a great deal.
What's wrong with this?
Yeah.
Yeah,
It doesn't-
doesn't it feel uncomfortable?
It doesn't
I'm going
sit
to give you a
right.
long-term care-like benefit
Yeah.
without checking your health.
There must be a catch. There must be something hidden in the fine print.
Yeah. So let me say it back a little bit differently, okay? Long-term care insurance requires a health exam because if you're doing traditional long-term care insurance or asset-based long-term care insurance, asset-based long-term care is you put a certain amount of money in there, and then if you need long-term care assistance, so you think of long-term care, that you're going to get a nice benefit for a couple of years. That's the idea. You have the benefit for life. You with me so far?
Yep.
They're going to check your health care because it makes no sense in the world to pay let's say $50,000 and get some huge benefit if in 2 years you need long-term care. That's not financially prudent for the insurance company. It doesn't work for them. They have to check to make sure, and these are my numbers, my opinions, that you won't use it for at least 10 to 15 years so that if you do use it, you're the exception to the rule, you're the statistical outlier, and that the insurance companies can stay solvent. If you use, let's say, index universal life insurance, they're going to check your health. They need to know that you're probably not going to die in the next 10 to 15 years, so that if you do, you're the statistical outlier, and that if you do need long-term care insurance, you've got the health sufficient enough that in 10 to 15 years and you start tapping into your death benefit because you've got terminal illness, chronic illness, whatever the rider is. Riders are the additional feature that's with your insurance policy, that the odds are in the favor of the insurance company. Okay, you with me so far?
Yeah. They're doing their due diligence because they need to make the numbers work so they can stay in business. Is that right?
Yeah.
If everyone who created a policy filed at once, then they won't have enough to pay everybody. Is that right?
Yeah, I mean, I guess this is so grim. I hope this doesn't happen. But let's say a city of 1 million people all got term life insurance for $1 million.
Okay.
Okay. And then let's say in, 5 years, there's a horrible accident and everyone in this city dies.
Ooh, yeah, that is grim.
And it qualifies now for everyone's term life insurance to go to some beneficiary.
Yeah.
That would really hurt an insurance company. Now, I'm not trying to gloss over the tragedy of what this is. I'm trying to be hyperbolic in something that's so crazy that it might, hopefully this doesn't happen. But can you see how that wasn't statistically probable?
Sure, yeah.
You don't buy term life insurance hoping to die in a year or two. You buy it in case statistically it happens. It was the unexpected outlier situation. So, okay. Now with the annuity, this is pitched over and over again. And what's almost never disclosed. So if you're thinking about annuity, read the contract. maybe even upload it to your favorite AI and have the AI also help you understand it.
Sure, yeah, it's a good tool.
AI are not attorneys,
All right.
okay, but it might help you ask a few questions that might help prompt a further conversation. Annuities are not good or bad, they're just a tool. But in the products that I'm aware of, there's many that do this, where your income doubles for up to 5 years if you have long-term care needs. That only lasts as long as the cash value lasts. Okay?
Is the cash value what you put in to fund the policy?
Yep. So this is not an illustration.
All right.
I'm not quoting any policy. I'm just saying an example just to illustrate kind of the mechanisms here. I love regulators because I think they do a good service. I just don't want to say something where they're going to be upset. So I try to over disclose everything. Okay? Because I want people to understand these concepts. Let's say you put, I don't know, $1 million into a policy, okay? And this policy is going to pay you $70,000 flat income for life. So remember, flat income, it doesn't increase, so inflation's going to erode this over time. So that $70,000 eventually is going to feel like $30,000. So just caveat.
Yeah, sidebar there.
It's the flat income, okay?
Yeah.
But if you need long-term care, that $70,000 is like $140,000 for 5 years. That sounds like a good deal. Well, what happens is the $1 million goes into an indexed, usually around like bond funds or something lower risk, so it's got lower growth. And so within like 10, 12 years or so, that cash value is gone. So if you needed long-term care help in the first 10 years, maybe you get it. But once the cash value is gone, it goes back to the $70,000. And they know if you're needing long-term care help in any capacity, you have a lower life expectancy from that point on. I think it's like once you need long-term care, it's like around 3 years to 5 years left of life anyway. So they don't mind giving you more of your own money back at a faster rate. But once that cash value hits zero, there's no death benefit. And they just go back to the $70,000. And yeah, they can kind of just wait a couple more years and then you're probably dead. So that's why they don't check your health insurance, or not your health insurance. That's why they don't check your health in advance, because the benefit is only based on your cash value. And once that's gone, there's what do they care? They already made money off of your money. And when you grab enough pool of people together, the odds are in their favor. So it works out for them. The reason why I'm saying this is it's not a bad policy. It's not a bad strategy. It's not a bad benefit. But don't think you're going to double your income at 86 years old when you need long-term care. That benefit's gone.
Because the cash value would already be gone by then.
Cash value is usually gone based on what I've seen and experienced and looked at about around 10, 15 years or so. I would expect for something based on what we've talked about. Now, there's other versions. There's other ways you could structure the policy. Less income that allows more cash growth, so it kind of lasts longer. But notice you had less income at the beginning. So there's always, to get something, you've got to give something up. There's always this negotiation of what do you want and what do you have to give up. Always going to happen. But don't think you can cheat an insurance company, and don't think insurance companies are charities. They're not. They're not bad. They're just a business. It's just insurance. But almost every time I've explained that to someone, they said, well, I'm glad I didn't buy it because that was never disclosed. I said, great. I guess we've made some progress here. And then we keep the conversation going.
Mm-hmm.
Long-term care insurance is as simple as this. If you need it, you probably can't afford it, realistically. And if you can't afford it, you probably don't need it. The only reason, in my opinion, why you might buy it is survivorship. So just in case someone gets, like you're willing to pay a premium to protect the surviving spouse, just in case, because there are certain lifestyle goals or risks that you're concerned about, and you're willing to pay for that premium just to have the peace of mind. That might be a reason. Another reason is you just want the peace of mind because you've got this legacy intention and you're okay just paying for the peace of mind. You're okay paying to transfer the longevity, or not the longevity. You're okay transferring the long-term care risk to an insurance company knowing the odds are not in your favor. But notice how we're defining things as they are. I've never actually sold a long-term care policy. I've done so many illustrations.
And what usually happens when you run those?
The people that really, really want it are denied
Uh,
because they know they're probably going to need long-term care help sooner than later.
uh-huh.
So it's like,
So the insurance companies, nope.
and we'll check. I mean, it doesn't hurt anyone to try and get a policy. If you know you might need long-term care sooner than later, what if the insurance company makes a mistake? That could happen. It's rare. I mean, it's worth checking. And then for the people that are really, really healthy, I just do a quick cost analysis and say, here's your protected category, here's your growth category, here's the benefits and risks of each of them, here's their liquidity needs, here's the health timelines. You know your health. How do you want to proceed? And almost once I lay things out, they almost never really sign up because things are explained as they are, very objectively. Yeah, I've never been invited to speak at a long-term care conference.
Yeah, and you're not doing yourself any favors now either.
But I'm fine. I'm licensed to sell them, and I'm fine giving a very open conversation about it because I'd rather you not buy it, and we structured the plan more appropriate. My business does better, admittedly, when I give more honest advice, when I give more transparent advice, because we make our money based on a flat fee schedule. So we need retention. We need that openness and transparency. It's not about putting all your money in the market. We're indifferent on where your money goes. But we do well when we have that objective conversation of what truly is right for you. And that does make us slightly unique. I mean, it's a subscription model, basically. How much does it cost to do the job? Great. Now let's really dive into the details and figure out what's right for you, because we're paid the same regardless of where your money goes. So that also kind of affects, I guess, our horrible long-term care insurance quotas, which are basically zero.
Yeah.
Because we've never sold one. But I mean, do you see my point here?
Yes. I mean, you just have to know what are the motivations for either the proposed insured or the insurance company, and do they line up? Where's the Venn diagram?
Yeah. Now,
Yeah.
one last note on this question. We've had many people come into our office already with long-term care policies,
Okay.
and they were amazing.
Ah.
They were priced wrong. The insurance company either didn't do an effective check on their family history, or they were just priced wrong and they got in at the good time, and then they changed the prices, but the insurance company in a contract has to honor it. And I'm going, you keep this thing. Let's if they're going to try and increase prices, in the 70s or so on, and there's a whole thing about that. To increase insurance price, it has to go through the insurance commissioner of the state. Sometimes they're accepted, sometimes they're denied. Like, there's a whole process of that. They can't do it willy-nilly, but let's build in an assumed price increase on these things so you can keep this.
Huh.
Because it is priced so well, it's in your favor.
But those are gone now, right?
You're not going to get those today.
That's too
The
bad.
insurance company's wised up. So I guess you could say I'm a really good retention policy for the old long-term care. The stuff that you got from your insurance or from your work.
Oh.
It's like a group long-term care insurance, something like that years ago.
Okay.
Yeah, those. It's it's like a relic. You hold it dear and close to your heart.
Yeah.
But long-term care is a tricky conversation. Just don't think that it's an investment. It's not an investment. It's the transference of risk. And sometimes that transference of risk is a high premium. Sometimes you got lucky. Just understand it's a cost-benefit analysis that needs to be done for you to understand what that should look like.